Hello, in this lecture we will continue on Chapter 6 talking about inventory costing. We're going to talk now about last in, first out. We have talked about the specific identification method and well as the first in, first out method. The first in, first out method is more intuitive to most people because it follows what we would expect to follow from the normal cost flow assumption, meaning that we would think that most businesses would try to sell the first thing that they bought would be the first thing that they tried to sell. They wouldn't try to sell the thing that they just bought if the items are homogeneous or the same in nature. We will be making that assumption now though, and the point being here is that it is just an assumption. We don't know what the exact sale of the item was, so therefore we could assume either way. It's a logical assumption for us if we're not going to track the specific inventory that was sold. It's argued that it's a logical assumption for us to assume any type of reasonable assumption. And the first assumption, if we can assume that first in is the first one out, we can also assume that the last one in is the last one out. This causes some weird type of formatting because it could leave layers left within the accounting structure in terms of we could have inventory that on our books hasn't been sold for a long period of time because it's still there and we've always purchased new inventory and therefore we've never gotten to sell this older items. So let's take a look at what this would look like. Once again, the reason for this might be that you would use LIFO maybe to try to lower your net income and thereby lower your taxes. So LIFO is thought of as a way in times of rising prices, which are generally the norm, that it would lower net income in that time period and therefore would be good for tax purposes. But it's also just a good thing to know in terms of the effects that different assumptions could have, assumptions that we use and need to use on the financial statements. So once again, we have the same numbers here and we have the same beginning numbers where we purchased 10 units at $91 for $910. Then we purchased another 15 units at $106. Notice once again that the cost of the units went up. So now that we have the same $91 and then 10 units at $91 and we have another 15 units at $106. Therefore, our ending inventory is now $2,500. Then we sold units. Now we sold 20 units. The question is, which units did we sell? Well, if we assume the last in, first out, we're going to sell the units that we just bought first. There's only 15 of them, therefore we're going to wipe out all those here at the 106, and then we're going to eat into the older units that we bought. So you can think of this kind of like stocking the shelves and putting the newest stuff right in front and never stocking the stuff in the back. That's the assumption being made. Again, the physical flow doesn't have to match the assumption because it's just an assumption. But when thinking through it, that's kind of the assumption that we are making. Therefore, we have 5 units left of these 10 at the 91 to make the 20. This would be the cost of the units sold, not the sales price. That's the cost. Be the sales price less this cost would be the effect on net income. How much do we have left? Well, of these 15, we wiped those out. We wiped the bottom layer out and sold all of those at the 106. And of the 10, we only sold 5, leaving us with 5 left at 91. So we have an ending inventory of 455 in this case. Then we purchased another 20 at 115. Therefore, we have the same layer as of this date plus the new layer, giving us the ending balance on our ending inventory of 2,755. Then we bought another 10 at 119 for a total of 1,190. And once again, notice the prices are increasing. That would be the normal trend, all else equal, just in terms of inflation in a usual normal market. Therefore, we have the first layer still there, the second layer still there, 5 at 91, 20 at 115, and now we have the new layer, 10 at 119, giving us 3,945. Then we sold 23 units. Question is, of these units, which ones did we sell under the assumption of last in, first out? Well, we stocked the things right on the top of the old stuff, therefore they're going to pick up the last units. So we're going to sell these first, 10 of the 119, the newest units, and that will give us this number. Then we need another 13 more to bring us to this 23. So we sold 13 of these 115 here. And if we multiply those out, add them up, we come up to 2,685. Not the sales price, that's what we bought them for. That's the cost of the goods sold. Cost of the inventory that we sold. Sales price less this cost of goods sold gives us the net income effect of this transaction. What do we have left? Well, we sold all of these 10 at the 119, and then we sold 13 of these 20, leaving us with 7 of the 115 left, and we didn't eat into any of the 5 at the 91. Those are still there, leaving us with ending inventory of 1,260. Now we're going to take a look at the average method. This is another one that is more more reasonable for most people. Average method being the middle between the FIFO and the LIFO. So the average method, we're kind of going to be thinking more like, well, some of them cost this much, some of them cost this much. They cost, about so much. So that's what the average is going to be. We're going to pick a number that could be representative of any of the units. Therefore, we're going to take the average, the representative number that would be the average of the highs and the lows of the costs. So if we take these same numbers again and we think about the average cost, we have the 10 units at the 91 for the 915 once again. Then we purchase another 15 units at the 106 once again. Therefore, we have the 10 units at 91 and we have the 15 units at 106. If we take the $2,500 that we have and we divide them by the number of units, which is the 10 and the 15, the calculation is going to be down here, the 2,500 divided by the number of units, we have an average cost per unit of, in this case, 100 per unit. So some of them cost 91, 10 of them did. Some of them cost 15, 15 of them did. So we're going to say, they cost about $100. So then when the sale comes along, then we have a sale of 20 units. And how much did they cost, those 20 units? Well, some of them cost 91, some of them cost 106, but on average they cost, about 100. Therefore, we're going to say the cost of goods sold is 2,000, and that's the cost, not the sales price. So the sales price minus the cost of goods sold, effect on net income. How much do we have left then? Well, we had the 25 units minus the 20. We have 5 left, and they cost, about $100. And that's going to be our new average. Then if we bought another 20 units at 115, then we have another 2,300. So then we have to do our calculation. So now we have the 2,800, and we're going to divide that by the number of units, which will be 25 in this case, the 20 and the 5. Calculation is down here, the $2,800 divided by the 25 units will give us an average price of 112. So we had 5 at 100, that was our last average. We have 20 at 115, that's what we just bought. So if we divide that out, the average is about 112. Then if we do this again, we bought another 10 units. Once again, the price went up to 119 in this case. So now we have 119 being the new layer. So if we had 5 at 100, we have the 20 at the 115, and then we have the 10 at the 119. That would be a total cost to us of $3,990, and we have 35 units, 10, 20, and 5. So if we divide the 3,990 divided by the number of units, 35, that means that we had some that cost 100, some that cost 115, some that cost 119, so they cost about 114. Then if we make a sale on August 31st, we will then have the 31 units at what are they going to be at the cost? And again, we have 5 at 100, 20 at 115, 10 at 119. They're going to cost about 114 each. Therefore, the cost of goods sold will be $2,622. Not the sales price, that's the cost. Sales price less the cost of goods sold will be the effect on net income. And now we have 12 units left at the 114. It's going to be the 35 units minus the 23 units on the sale gives us the 12 units left at the same average price of 114 in this case. So financial statement effects of the costing methods. So notice that these are three different types of assumptions, and they're going to have different effects on the financial statements. So because price changes, inventory methods nearly always assign different cost assumptions. So if we look at the specific identification, the FIFO, the LIFO, and the weighted in terms of the income statement, in this case, we're going to take a look at the income statement. The accounts that we're focusing on is cost of goods sold when we talk about the income statement. And the bottom line number, which is of course net income, down here, our gross income being the sales less the cost of goods sold. Our major expense in income statement where we sell inventory is, of course, cost of goods sold. The specific identification less the cost of goods sold that we came out from that calculation will give us the 1,465 less other expenses and whatnot, brings us down to our net income of the 713. Now the specific identification, we don't really know if that's going to be higher or lower. It just depends on which ones we actually sold, which could be the higher or lower amount. If we look at these three assumptions, these are the three that are assumptions and not the actual specific things that were sold. The first in, first out, you'll note that we have the same income to give us a comparison. Cost of goods sold will be the 4,570 under this method. That leaves us a gross income of 1,480 and our net income 721. If we assume LIFO, remember this was the period of rising prices, our sales are the same because we sold them for the same amount. But the cost of goods sold now is higher, 4,730, which makes our gross income less, which makes our net income less. So note what happens between these two methods. FIFO, under a period of rising prices, all else equal, that is the assumption that will happen, things will cost more over time, will result in a higher net income than LIFO. FIFO will make us look better than LIFO. That would be good for like stock shares when we're trying to make ourselves look better. So that's the normal assumption that we would want to look better. And the FIFO generally does because it increases our sales and it increases inventory, as we'll see in a second. But if we're thinking about taxes, we don't want to look good. We want to look worse because if we bring the tax net income down, we pay less taxes. So that's why the LIFO could be a method tried to use to basically lower net income to look worse, which would be beneficial for taxes. And notice that the weighted average, of course, is in the middle. They cost about the middle number. So we come out with the middle gross profit and the middle net income. On the inventory side, if we think about FIFO, this is on the balance sheet now, under assets on the balance sheet. So we're only showing one line item of the balance sheet, whereas we showed the entire income statement up here. So inventory as an asset, FIFO would be higher because we're left with the newer items that we bought in ending inventory, which we assume we cost more under the normal increasing cost assumption. LIFO, our assets look worse. Our assets are lower because we assume we have the older assets and those cost less, average in the middle.